A cryptocurrency exchange is a digital marketplace that allows users to trade crypto assets with one another. There are two types of exchanges, decentralized and centralized. What is a centralized exchange? How does it function? And what are the benefits and drawbacks of using it? But first, hello and welcome back to the channel. This is Crypto Talks, where we talk about cryptocurrency and all you need to know in the world of finances. And we're back with another incredible video. So please subscribe to the channel and enable alerts to be notified of each new upload. Many of us are attempting to gain a better understanding of the burgeoning world of cryptocurrencies as we stand on the cusp of a new asset class. Crypto, like the old Wild Wild West, is undergoing constant change. Both evolutions as well as potential setbacks to which we must adapt and comprehend the long-term mechanics of what will certainly become a critical component of our financial infrastructure in the next years. The crypto exchanges themselves are a key piece of technology that benefits from growing participation in cryptocurrencies. They are unable to operate on the traditional stock exchange model. These are impressive technology pieces that deserve a note or two to explain the mechanics and differences from the old world model. Without further ado, let's explore centralized exchanges. The Centralized Cryptocurrency Exchange is one of the most essential platforms for trading for most digital currency investors. Online platforms for buying and selling cryptocurrencies are known as Centralized Cryptocurrency Exchanges. They're the most frequently utilized option for investors to purchase and trade cryptocurrencies. Although digital currencies are often marketed as decentralized, some investors may find the concept of a centralized exchange to be misleading. What does it mean for an exchange of this type to be centralized, and why are these exchanges so important for the success of the cryptocurrency industry as a whole? The term Centralized Cryptocurrency Exchange refers to the use of a middleman or third party to assist with transaction processing. Buyers and sellers alike entrust their possessions to this middleman. This is typical in a bank setting where the consumer trusts the bank to keep his or her money safe. This system is in place because banks provide security and surveillance that an individual cannot obtain on their own. The same argument applies in the case of a centralized Bitcoin exchange. Transactors trust that the exchange will not only safely complete their transactions for them, but that it will also leverage the exchange's network of users to identify trade partners. When it comes to cryptocurrencies, which are frequently housed in digital wallets, losing the key to a wallet can result in a loss of hundreds or thousands of dollars in digital currency holdings. An exchange, on the other hand, will not allow this to happen since it protects the holdings of the individual investor. At this stage, a centralized exchange is more likely to offer cryptocurrency/cryptocurrency pairings. Customers would be able to trade Bitcoin for Ether tokens, for example. Fewer exchanges offer fiat currency/cryptocurrency pairs, allowing, for example, Bitcoin to be exchanged for USD. However, these fiat or cryptocurrency pairs are offered by some of the world's top cryptocurrency exchanges. Part of this is probably due to the fact that they provide direct access to the Bitcoin market. Because many investors in the industry are new to digital currency investment, they are more inclined to use these type of exchanges. So, as previously said, centralized cryptocurrency exchanges operate as a middleman between a buyer and a seller. Centralized exchanges are more reliable because they are run and regulated by a corporation. Centralized exchanges handle over 99% of all crypto transactions. Coinbase, GDAX, Kraken, and Gemini are examples of centralized cryptocurrency exchanges. Decentralized cryptocurrency exchanges, or DEX, on the other hand, allows users to conduct peer-to-peer transactions without the involvement of a third party or middleman. Decentralized exchanges are chosen by certain users due to some of the disadvantages associated with centralized exchanges. Decentralized exchanges don't allow for the exchange of fiat currency for cryptocurrencies. AirSwap, IO, BarterDEX, and BlockNet are examples of decentralized cryptocurrency exchanges. New centralized Bitcoin exchanges keep showing up on a regular basis. Nearly all of them, though, will succeed, although it's not rare for these trades to fail. An exchange's success or failure is determined by a variety of factors. Trading volume is one of the most important aspects of success. In general, the bigger the trade volume, the lower the volatility and market manipulation that is likely to occur on that exchange. Volatility is an important factor to consider. The price of a specific token or coin can change between the time it is initiated and the time it is completed, due to the time it takes for transactions to be completed. The less likely this volatility is to be a problem, the bigger the trade volume and the faster the transaction may be performed. Security is another important aspect of a successful centralized exchange. While no exchange is fully protected from harmful behavior such as hacking, some are very close. It's far from certain how an exchange will react to an event like a hack. Some exchanges have worked hard to compensate consumers for their losses, while others have had less success, and yet others have had to close their doors as a result of such attacks. A centralized exchange is still the most popular way for investors to get into the Bitcoin market. When choosing an exchange, bear in mind a variety of aspects that will influence the user experience, such as the types of pairings traded, the amount of trading volume, and the security measures exchanges have implemented to protect their consumers. Well, hello there! We've made it halfway through our discussion, and we sincerely hope you've enjoyed it thus far. If you have, please give us a thumbs up and turn on notifications to be notified of new uploads. We've already discussed the fundamental aspects of centralized exchanges, but at this point of the video, we're going to help you decide between decentralized and centralized exchanges by going over their advantages and disadvantages. Let's start with Decentralized Cryptocurrency Exchange's benefits. Decentralized exchange users are not required to transfer their assets to a third party. As a result, there's no possibility of a firm or organization being hacked, and users are protected from theft and hacking. Decentralized exchanges now avoid market manipulation by enabling peer-to-peer cryptocurrency exchange. This protects customers against false trading and wash trading. Last but not least, decentralized exchanges do not need clients to complete Know Your Customer (KYC) forms, allowing users to maintain their privacy and anonymity. Let's now turn our attention to its drawbacks. Users of decentralized exchanges must remember their crypto wallet keys and passwords, or their assets will be lost forever and will not be recoverable. Unlike centralized exchanges, which provide a more convenient and user-friendly method, they demand the user learn about and become comfortable with the platform and process. Users who don't already own cryptocurrencies will find decentralized exchanges less convenient because they don't allow them to trade fiat currency for digital ones. Centralized exchanges facilitate 99% of crypto transactions, implying that they are responsible for the vast bulk of trade volume. Decentralized exchanges frequently lack liquidity due to a lack of volume, making it difficult to identify buyers and sellers when trading volumes are low. Now let's turn our attention to the advantages of centralized management. There are some intriguing advantages to having exchanges operate as a full-stack product, rather than dealing with a half-dozen separate parties in a single procedure in a developing financial sector. Beginner investors will find centralized exchanges to be a familiar and comfortable way to trade and invest in cryptocurrency. Users utilizing centralized exchanges may log into their accounts, examine their account balances, and make transactions through applications on websites, as opposed to using crypto wallets and peer-to-peer transfers, which can be complicated. When it comes to transactions and trading, centralized exchanges provide an extra layer of security and reliability. Consolidated exchanges provide greater comfort by allowing transactions through a well-developed, centralized platform. Let me now discuss the drawbacks of centralized cryptocurrency exchanges. Companies that operate centralized exchanges are liable for their customers' assets. Large exchanges typically house billions of dollars in Bitcoin, making them a target for thieves. Mt. Gox, which was formerly the world's largest cryptocurrency exchange company until reporting the loss of 850,000 Bitcoins and being suspended, is an example of such an instance. Unlike peer-to-peer transactions, centralized exchanges frequently levy substantial transaction fees in exchange for their services and convenience, which can be particularly exorbitant when exchanging large quantities. As investors looking for possibilities, where do we go from here? It's crucial to remember that this is still a new business, so these exchanges, like the tokens they trade, are still figuring out who the genuine winners and losers are. Is this to say you shouldn't go out and buy from Coinbase? Certainly not. However, there is still a technology hierarchy among the participants in this market. There are undoubtedly exchanges with better products than Coinbase, just as there are undoubtedly exchanges with poorer. There will be a lot of M&A and IPO activity in this market, at all levels and sizes. However, only a few companies will be able to buy from a huge player like Binance or Coinbase at their current sizes. Although Coinbase, as a huge publicly traded company, has the greatest ammunition, there is still room for private acquisitions and subsequent listing across a range of other market participants. The focus should be on the quality of the technology and the ability to scale up client offers and values, as these will be some of the most important determining factors for market staying power and the potential to monetize market share further. What do you think? Is centralized cryptocurrency exchange worth it? That concludes today's video. Please subscribe to the channel and enable alerts to be notified of new uploads. This is Crypto Talks, and we'll see you in our next video.